Ladies and gentlemen, welcome to today's webinar. It's the 7th of this year. Today we are really happy to welcome you for this webinar. We're going to talk about oil and gas and petrochem market outlook for Q3 2021. As you know, we are really trying to follow the market as closest as possible. So we are really happy today to give you this update. Before starting and going to the matter of the topic of today, just a quick look to stay tuned on our agenda for the next and coming event. Of course, the next webinar is already settled. It will take place on the 14th of December, same timing, Central Europe time, and we will focus on energy transition markets because today we focus on oil and gas and petrochem. Next one, we will focus on energy transition, meaning hydrogen, carbon capture, electrification, solar, windmill, and all the energy transition projects that you could cover. Few rules and rules to remember for this presentation. First, if you want to ask any question, please feel free to do it during the presentation. You have a Q&A section at the top of the tool where you can ask any question. We will address all of these questions at the end of the presentation directly. In the same way, if you want to receive the video, the replay of this event, and receive the invitation for the next webinar, I invite you to follow us on LinkedIn directly on To Be First Consulting page. And of course, you can still request us the slide we are going to use today by sending me an email at the address you see on the screen. It's already in the comment section, so you just need to click and send me an email to request the slide. So I hope it's going to be interesting. If we look at the agenda today, we'll start by a few introductions about who we are, what we do, and a few basic rules about our project database, Project Smart Explorer, because we are going to give a lot of figures today. So it's quite important to know where those figures are coming from and what are the logic behind. Then we give you some news about the market, what is the petroleum demand, because it has been changing a lot in the coming month. Then we'll tell and discuss about the market shift, a topic that we were discussing already, but now it's getting a lot of momentum, and we'll put figure on that. Then we'll talk about the project outlook as we see it for oil and gas, petrochem, and energy transition. And of course, we'll finish by a focus on the new business model before going to the conclusion and answering your question directly. So just a small introduction of ourselves to start. Today you will be, let's say, hosted at this webinar by mainly Jean Charles and myself. Jean Charles is an engineer and is quite well experienced. He has been working more than 25 years in the oil and gas industry. At a point, he was vice president of ABB Group in charge of all the oil and gas. So it's really a well-known, let's say, figure for all the oil and gas industry. And he quit ABB, in fact, to create his company, To Be First Consulting, and to develop this Project Smart Explorer database that we are going to look in more detail in a few seconds. And myself, Jean. So Jean Charles and I are related. We work together in To Be First Consulting. And I'm an engineer as well, and I've been working for Siemens Oil and Gas, where I was in charge of developing all our digital portfolio. Not going to go through all our references, but if you're interested to know more about it, I invite you to go to our website and see the experience we may have. Now, some rules and some logic behind Project Smart Explorer, which is our project database tool and solution. The logic behind is we try to focus at least 1,000 projects really at pre-feed and feed phase. And inside those projects, there is two thresholds. We focus on the project in oil and gas and petrochem where the threshold is above $100 million capex. And for an energy transition project, which are smaller, we have this threshold about 10 million investment capex. Of course, this is a rule for project to enter the database. Project get out of the database 6 months after the EPC contract is awarded, meaning we really try to focus our database on project where the business is still open. So if we look now at the, let's say, the scope of those projects, those 1,000 projects, they cover all the oil and gas industry, so meaning the upstream and midstream industry, all the petrochem industry, so all the downstream, the aromatics, the ethylene cracker, all those kind of example. And of course, we focus on all the energy transition that we may have a slide to present in more detail. Just to remember that Project Smart Explorer is really the tool if you want to follow and prepare, I would say, the energy transition, because there is a lot of opportunities today on the market. So of course, it's the right time today to interact on those projects, to capture the first references and make the best out of those coming industries. So in Project Smart Explorer, we have been covering for now more than a year all the electrification, carbon capture and storage projects, the hydrogen, the ammonia, what is solar, windmill, waste to chemicals, recycling activities, SAF, sustainable aviation fuel as well, water treatment, power generation, and energy storage. We have still updated this list to increase even more the scope of projects we have in the database. So if you want to take advantage of the energy transition, you need to act now, and we are able to help you in doing so. So enough for the presentation. Now I'm going to pass the ball to Jean Charles directly. He will be the one taking the lead and joining you today. So Jean Charles, you are now on the screen. I leave you the floor to run the presentation and run the show.
Thank you, Jean. Thank you very much for this introduction, and thank you everybody to join this webinar. And yes, this focus is now to the purpose of this presentation, as I mentioned, Jean, is to watch out what came out from the third quarter of this year on this market, in parallel of what you may have seen from the news and medias so far, and how we can analyze this market from our side. The first macro view I would propose you is this curve issued by Energy Information Administration from the US in September 2021, comparing the world production with the world consumption. And you can see that until the end of 2019, both were running pretty well in parallel to more or less 100 or more than 100 million barrels per day. Then, of course, with the COVID, the consumption has collapsed to 85 million. The production has slowed down more or less on the same pace. And then slowly after April 2020, consumption and, of course, production has started to come up again. At the end of Q2, meaning end of June, we were around 96 million barrels per day. Today we are about 99 million barrels per day, so which means that this forecast coming from September 2021 is very much verified, and the demand, as you can see, is pretty solid and pushing the price of the barrel to the sky now, precisely because, of course, on one side people call to stop investment in fossil fuel, but on the other side the demand is still there. Not only it is still there, but it is continuing to increase. And if we want to compare precisely from where the oil is produced and from by whom it is consumed, you have on the left here the production of oil over the last 3 years between OPEC in dark brown and non-OPEC countries in light brown. And you can see that OPEC is fluctuating, OPEC countries are fluctuating between 38 and 31 or 30%. And in fact, that reflects how much is the strategy of OPEC to control the market, in having a market share always fluctuating between 30% and 40%. And for OPEC, that's clearly a goal to always have a market share above 30%. That's what we call the glass floor. I mean, OPEC will go at war in the market as soon as their market share is going down below 30%. But in the same time, yes, we can expect OPEC not to increase their market share above 40%. They want to leave the market anyway floating to a certain extent. Regarding the consumption of this oil, that's interesting to compare OECD countries in non-OECD. And what you can see is that after the COVID, the consumption of OECD countries is increasing. Of course, it comes up again, but not at the same level as before COVID. Clearly, what we see is that the industrialized countries, which are part of OECD, are not they push their economic recovery, of course, but not but in limiting their consumption of fuels. That's pretty interesting. But that is not the case on non-OECD countries, and that's interesting to see the difference in terms of behavior between non-industrial countries, let's say, and industrial countries, where non-industrial countries need more energy, more fossil fuel to support their recovery, economical recovery. We can also have a zoom here on the who is the origin of what in terms of production, and that will help us to get a better understanding from where the investment will come or where the investment will be concentrated. Here on the curve on the left, you can see again the production of oil falling from 102 million barrels per day in average to less than 90 million, and then increasing again step by step to where we are today at 99 million barrels per day, with an expectation to be again at 102 million barrels per day in 2022. And all forecasts give consumption or production of barrel around 102 and 108 million barrels per day for the next decade, and to come down or to be a plateau, let's say, by 2040 or 2050. But until then, the anticipation is to have a production of oil around that numbers. Where it will come from, you can see, I mean, OPEC countries are appearing here in green, and they were the one to pull the brake, of course, during the COVID. During 2021, they reduced their production as well to regulate the market, as we said earlier. But you can see in 2021, they have started to invest, and they represent about 50% of the additional production. And for 2022, the OPEC countries should double their contribution to this recovery by 2 additional million barrels per day compared to 1 in 2021. So OPEC countries will double, let's say, their additional production, their marginal production between 2022 and 2021. What is interesting is that to see what is doing the rest of the world. So you have, of course, North America in dark blue. You have Asia and Euro-Asia, which include Russia, in dark blue, very dark blue, and you have Latin America in light blue. And you can see that the non-OPEC countries altogether, which has added 1 million barrels per day compared to last year, will add 3.3 million barrels per day in 2022 compared to 2021. So, which means here that even if OPEC is leading the game, we can see that the biggest increase of oil in 2022 will come from the non-OPEC countries, and North America by far in the lead. So you guess USA and Canada, but mostly USA. That's the first hint. And in correlation with USA, if we zoom a little bit deeper, let's say, on the different players we find in the USA, we have, of course, the majors, okay, like Chevron, Exxon, Shell, BP, and so on. They are here in this light blue or light green color on that curve, and you can see that they have not contributed so much and so far to the increase of production in the USA, despite the price of the barrel increasing. Okay, they remain very, very cautious just to maintain the production as flat as possible. By independent company, we understand independent companies, of course, but with which are listed anyway, or backed by financial institutions. So pretty large companies, even if they are still independent. Those ones have slowly increased their production, but really slowly, and clearly today they give priority to pay dividend to their stakeholder before investing their cash flow in increasing the production. For instance, they want really to take advantage of the high barrel price to return a better cash flow to their stakeholders. That's really the priority of this company. And then you have the fully private companies. So fully private companies are mom and dad companies, as you may be yourself or whoever you know. It's a family company, and you can see there are plenty of them in the USA, as you know, and those ones go very aggressive in increasing the production. So it's very interesting to see how much in the USA the different profile of operators behave in total different ways in the same circumstances, and the response time is very different. And the logic behind that, the smaller the companies are, the more responsive they are. So it's not really new as phenomena, but that's something which is verified here and contribute. And we can see then that USA therefore has a huge reserve of production capacity increase on coming months, and we can anticipate that USA will become in 2022 a key player, maybe the first production of oil in the world in 2022, even though, as you know, Joe Biden and his government are pushing hard in favor of limitation of temperature and global warming campaign and so on. Regarding the gas behave in a different way from the oil. It has always been the case. First, because there is no global market free in gas, that's the difference with oil. In addition, gas market is a very cyclical market where in winter or before the winter, the consumption is increasing, and then in summer, the consumption is decreasing. And you can see the bar graph on the left showing, reflecting this cyclical phenomena of the gas market through LNG market, and you can see that in 2020 and 21, in fact, the market, the consumption of gas has continued to increase despite the COVID. So that the first, so the first conclusion we can draw is that gas market is not sensitive to the COVID. That's the first conclusion. The second point, you have it in the curve in the middle, where you can see in green 2018, in yellow 2019, in red 2020, where the consumption has go down a bit deeper anyway because of the COVID, but you could see that it came up very quickly. And then you can see in 2021 how much the global demand for gas is exceeding all previous years and is reaching the high sky. And of course, it has pushed the price to the roof, we anticipate that the gas price would stay at pretty high level because the demand is exceeding LNG capacity of production today. And you may have noticed that the number of projects of LNG are starting to move on again to answer this demand, but unfortunately it will take a couple of years before this new capacity of production will be able to catch up with demand. Regarding the petrochemical market, we have of course the same phenomena, because the production of oil and gas is not to supply the food and beverage industry, is to supply the petrochemical industry, of course, and transportation. And regarding the petrochemical industry, we have this statistic, these figures from DataBridge Market Research Organization, which shows how much behaves the ethylene market since 2020, and you can see that it is increasing by 25%, nearly 30% in 2021. And in fact, we can expect that by 2023, more or less, the market will have doubled compared to 2020. So we can see a market for ethylene increasing extremely fast, just because, in fact, the global demand for manufacturing goods is booming, and you cannot have manufacturing activities without having ethylene and polyethylene as a main source of supply of manufacturing goods. As you know, brown goods, white goods, and so on, cars, phone, computers, airplane, and so on. Of course, they use aluminium, steel, and a number of metals, and no question on that, and many other things. But the key components is plastic or fibers, and under all the varieties, and that's what we find all over the world. It can be in Europe, it can be with the energy transition, which is a huge consumer of fibers and plastic, or North America, of course, and Asia Pacific, which is, of course, obvious. Another indicator which is very interesting is the air traffic. Here you have different colors corresponding to each year. So to go fast, you can see that yellow is 2018. The one on the top in red is 2019. The dark blue is reflecting the drop in 2020, where most of the air traffic has been grounded, and in violet you can see 2021, at least the first half of 2021, and you can see that at the end of June we were 10% below 2019, which was the highest year. So we can see that with the vaccine passport or the green passport, air traffic is not yet back to normal, but we are only 10% below 2019, and we anticipate that by the end of this year or beginning of next year, even though it should come additional wave of COVID, now all the government have learned how to manage that, and the vaccination campaign are paying back, allowing people to travel around the world nearly as usual. So all these changes anyway had a big impact on the market. And during this period of COVID, it started maybe a little bit before, but it has accelerated during this COVID to, let's say, recompose somewhere the structure of the market, and that's what we call the market shift. What it means is here we compare 3 years, 2019, 2020, and 2021, at least so far as of today. And we compare the EPC contract awarded on these respective years, and we analyze those EPC contracts awarded depending on the profile of the operator. So in blue, if we take 2019 on the left, in blue we have the international oil companies. In red, so international companies means Shell, BP, Exxon, Total, and so on. In national oil companies, we have Saudi Aramco, Petronas, Petrobras, all those state-owned companies, so about 100 of them. And in green, you find all these independent, as I mentioned earlier, which are not international companies, which are not national companies, which may be nice and big companies anyway, but independent company like Tullow, for example, Premier Oil, and many of those like that, mostly from the UK or from the US. And in 2019, you can observe that the market was pretty well balanced between those three categories of players, 30% market share each in terms of capital expenditure. In 2020, you could notice that, the international companies have lost half more or less of their size, while the independent company were about stable, and the national companies have increased their position. And then if you look at 2021, you can see that this phenomena has increased even more. In fact, among the international companies, except Exxon and Total, who have maintained some kind of normal activities, all the others have frozen all their investment. They are reorganizing their finance, they are reorganizing priorities among their assets. They spend more money to buy back shares and to invest in new projects. They try to maintain their stock exchange value as by different financial operation, but they are not in oil and gas and petrochemical operation. And that's a big change. And so for the companies, if you are a supplier of this industry, if you are a contractor or a subcontractor or an equipment, original equipment manufacturer, what so-called OEM or a system supplier, and you focus on IOC, that's a key point to consider. The market is clearly shifting from the international companies to the national oil companies and independent companies. And that's very important to realize that, because in 2021, you can see that the volume of investment has already, as we speak today, increased 2019. Okay, 2019 was not that a bad year, it was even a good year, but 2021 is already exceeding 2019, but not at the initiatives of the international companies. So that's very important to realize how the market now is dominated by different players. So now let's focus on projects themselves and how the market is going to behave. Here we shall compare year per year the volume of investment in terms of capital expenditure, and the year you see is a year when the EPC contract is awarded. Okay, so that's the reference we take here. In red you have the petrochemical. In oil and gas, you have in blue, and energy transition is in green. So until 2020, we have actual numbers, of course. And in 2021, 22, and so on, we have here the years with the forecast as we see it from now. The fact that this forecast is going down after 2022 is not reflecting that the market should decrease after 2022. It just reflects the vision we have on the project on those periods. And of course, the further we look, the less visibility we have, and that's the reason why the curve is decreasing. It's clear that we have a very detailed view on what's going to happen in 2022, but we have a much less view in what is going to happen in 2027. Okay, it's a little bit like when you drive a car at night. You have a good visibility in front of the car with the light or the light beam of your car, but beyond the light of your light beam in the car, you don't see anything. So you have to move forward, and then of course you discover the road ahead of you. So it's the same phenomena that you have here. What we can notice from this bar graph is the ambition. How high is the ambition of operators to go with new projects in 2022, 23, and 24? And we can even say that this ambition is so high that there is little chance that the market is going to happen at that level, at that high level, because entering company would not be able to absorb that. And part of this forecast, of course, we don't know yet which project, but we'll update the database on a daily basis on that. A part of those projects will be postponed and delayed to the period 2025, 2030. So we can, anyway, from this curve and the vision we have today, anticipate that the decade until 2030 will be pretty robust, just because we have already more than enough projects identified for the coming 3 or 4 years. If you look at where we stand now with EPC contract awarded year per year, so here we have the same bar graph as before, except that this one is reflecting actual numbers. And you can see that actual numbers for 2021 are already exceeding 2020. They are nearly at the same level of 2019, and we can anticipate that at the end of the year, 2021 will exceed 2019. The other point I would like to highlight here is to realize how high is the volume of business already awarded for the coming years, 2022, 23, and so on. And that's very important, and that relates to a new business model that more and more companies are adopting today, where they convert the feed into EPC contract directly without any tender. And that I'll come back in a few slides on more detail on this phenomena, but that has a big impact on the figures you can see today, and it will have a big impact on your business as well for the future, and we'll come back on that in a few slides. The key point here is for 2022, just to compare the forecast with the actual numbers. is that, again, what is awarded is captive, is what we call a captive market, even though the sanction has been made in 2021 or 2024, 2022. So it means that the contractor is known, is nominated, but also all the suppliers, most of them are already known as well. So it means that the project will come into execution in 2022, but with vendors, subcontractors, and so on, already decided and selected in 2021 and 22, with in most of the cases frame agreement being in place, and they will come in execution in 2022. In light blue, you have the part of the potential business to be awarded in 2022, in addition of what has already been decided. And then in green, you can see what is going to postpone because, okay, project will not be ready, the financing will not be set up or whatsoever. So you can see a big gap coming up more and more between the perception of the market, what shall be tendered in light blue, and the reality of the market, which also include what has been already awarded in previous years, but coming into execution on coming years. Then that's something pretty new, and we encourage you to have a look at it. Regarding the geography of the project, we can compare things where you have here the split on the top of the project per oil and gas, petrochem, and energy transition. And then on the lower part of the slide, you have the repartition of the business per region where the project have happened in 2021. So here we talk about actual numbers of EPC contract awarded. And by far, you see Asia Pacific region in orange dominating, taking the lead. Then in dark blue, you have North America, and then in violet, you have Middle East. And it's interesting to see the huge gap between those three regions and the rest of the world. Africa is far below, Europe, of course, is far below, and South America is nearly nothing but negligible. If we look now at the forecast with the same definition, you can see that, Asia Pacific in orange remain in the lead. North America and Middle East remain also pretty strong, but we see Africa coming back on coming years. And that's interesting because Africa had a very low profile this last 10 years, as you know, and we anticipate that Africa should become again an attractive region on the next 5 years. The rest would be anyway marginal, at least for oil and gas and petrochem. If we look where those projects are located from a Google map point of view, you have here the green dot representing the project. You have the orange, red, and violet dot representing the engineering companies working on those projects, and the blue dot represent the end users location. And you can see that most of the projects are concentrated in Europe, Asia Pacific, Asia Pacific, yes, and Middle East, and North America here. New business model and trend. So that's something I mentioned earlier. And in 2021, we observed that 40% of the EPC contract were not tendered, but they result from the conversion of the FEED contract into EPC contract directly, and by a deal made one-to-one between the operator and the main contractor. This kind of business model has always been existing. Sometimes it was referred as competitive FEED, but here it covers competitive FEED, but not only, because in many cases there is no competitive FEED as well at all. I mean, it's just the contractor in charge of the FEED and agree with the operator on the price and delivery time to move into execution right away. So there are different reasons for operators to adopt this business model. First of all, is due to new players to adopt this business model, and especially amongst independent, just because they have no money to organize a tender for an EPC contract. For them, time is money, and you know that tendering an EPC contract is time consuming. So, but they have their profit will go on the time they start to produce. So for them, time is money. The third point is really to cut the cost by more than 20%. Clearly, the operators which are going for that business model, they intend to cut the cost of the project by 30%, 40%, maybe 50% in the case. And you understand that when a project is tendered at the EPC contract, for the EPC contract level, when the standards, specification and vendor list is known, there is no way to expect to cut the cost in those proportions. In the best case, you may expect 5, 10%, maybe 15%, but no more than that. If you want to recut the cost in double digit, in that proportion of 20, 30% or 50%, you have to think out of the box, and that is only possible during the FEED stage. And that one of the main reasons for operators to be interested in this business. And the consequence of this new business model is it requires new pricing model for OEM and contractors, because if you submit budgetary prices during the FEED stage, you have, of course, no chance to be selected in these cases. You have to be much more aggressive to use what we call, for example, open book pricing, and then be able to sign frame agreement during the FEED stage so that you can secure your business when the EPC will come into execution. That's something we can discuss later on, but you have really to consider and to evaluate case by case for each project. If you are in a conventional business model where you will submit a budgetary price during the FEED stage with more competitive price and then rock bottom price when the EPC contract is awarded, or if you are in this new business model, and in this case you should offer an open book pricing if you want to expect to be selected at that stage. In both cases, you can understand that FEED is king, and that's a key conclusion to make from here. So here you have the description and the comparison between the two processes. On the top, you have the traditional business model with pre-FEED, FEED, with a final investment decision being made at the end of the FEED when the EPC contract has been tendered and the selection of the EPC contractor has been selected and nominated. And on the bottom, you have the new business model where the EPC contract is issued from the FEED before the final investment decision being made. So here you have the pricing model I was referring to. So on the grid, you have the traditional pricing model with the budgetary price during the FEED, then competitive pricing during the tender of the EPC contract, and the rock bottom price when the EPC contract is awarded. But then in parallel, with a new business model, we recommend you to use open book pricing, where you can adopt a much more aggressive price during the FEED stage in order to be selected at that stage as an OEM, as a contractor or subcontractor, but with condition that you can review and adjust to adjust your price when the project will move into execution, so that you can be competitive on one side to help your client, but you also preserve your margins by the condition you put in this agreement that you signed during the FEED stage. So the key point here is really to, again, adopt the right pricing model to the right business model of the project you have in front of you. So before submitting a quotation, it's important you know in which context you are. So here it's an example that you can find on Project Smart Explorer, where we tell you if it is an old conventional business model or a new business model. On the top, you have a conventional business model, so maybe you have hard to read it, but what it says, it shows here, is a list of all the bidders in competition for the EPC contract, since our database contains all the bidders in competition for the EPC contract, and therefore you can guess that you are in a conventional business model. In opposite way, in the foot of the page, if you see that for the EPC contract there is only one company named, and in addition this only one company is the same as the one who has made the FEED, you of course can make the conclusion that this project will follow the new business model, where the EPC contract will be issued or is already issued from the FEED, and in this case you have to adjust your pricing model accordingly. So in the database will give you all indication to make sure that you identify in which context is each project, so that you can adjust your pricing model accordingly and secure your offer, and not to work for hope, quoting for hope, but quoting for order. And that's expectation of any supplier in this market. So in conclusion, Q3 confirms the trend we observed during the first half of 2021. Okay, the market is not just recovering, but is running full speed, and we anticipate that the demand for carbon molecules, I would say, and fossil fuel will remain pretty high because of the economical recovery, but also because of the energy transition investment, because most of the technologies or solution, solar, wind, and so on, in fact, will use fossil fuel in one way or another. And so the demand for oil and gas and petrochemical today is not a question for the next decade, and we don't see how we can get rid of it in the next 20 or even 30 years. The question is about how to decarbonate this industry, of course. And that's where energy transition projects are the answer, of course. It goes by electrification, it goes by hydrogen, by carbon capture, by recycling, and many other detailed applications that you will see in more detail at the next webinar, by the way. But that's where both are combined together. So at the end of the day, it's very interesting to observe how much energy transition needs energy, meaning power in one way or another, and carbon molecule. For example, for the fibers required for a windmill. And so we observe some kind of snowball effect today between the investment in energy transition, pulling the demand for more fossil fuel, in the same time that the overall industry is also asking for more fossil fuel. So there is this snowball effect that we anticipate to load the project pipeline, business pipeline, for the next 5 to 10 years, and that we already observe on that respect. That's for the overall trend on the market. Regarding the way to do business, yes, here there are many changes. There are many changes because, as you could notice, the players in the game are not the same. Okay, international oil companies become marginal into the market. Maybe they will come back in the future. We can hope they will come back in the future, of course, but it will take time, and nobody knows exactly in which format. But anyway, what you must take as a takeaway for now is this new business model becoming a rule in the market where feed is king. And if you are not in the feed, you will disappear from the market, as simple as that. So that's the main conclusion to keep in mind for your management. Tension on the supply chain, okay, you understand that. I mean, that's why we see the gas price going to the roof, we see the oil price going to the roof. As long as we are below 100 million barrels per day, we can anticipate that, okay, the actual investment will manage to cope with the consumption. But if really the consumption of oil is increasing above 102, 105 million barrels per day to go to 108 million barrels per day, as some people anticipated, then it will remain a huge tension on the supply chain, because investment in the fossil fuel industry today, or in exploration production, for instance, and oil and gas production, is today far to meet this volume. So that means that it will be a huge tension on the supply chain on that respect. So now, if you read this information in a proper way, not only you should be able to focus on projects easy to reach, because there are plenty of projects, so the game is not to find new projects, the game is to find the project easier to reach. But because of the tension on the supply chain, it's also important to focus on projects which are easy to execute, and that's a different story. Because if you end up in the pursuit of the project at the EPC stage, you are at the end of the decision process, you are running late in the delivery, and therefore you are highly exposed to change orders, low prices, a short delivery time, and to burn all your margin in those projects. In opposite way, if you manage to sign frame agreement at the FEED stage of the project, in this case, you have a long-term visibility on the project. You can anticipate your production, you can anticipate your supply of components for the execution of those projects, and that's where it's very important to select carefully your project, not only to grow your business, but to preserve your margin in that respect. Otherwise, you may load your backlog, of course, but with projects which are time bomb for your profitability, and that's the risk today for a number of companies which are not able to work at FEED stage and to preserve their and to protect their backlog by high quality orders, I would say, precisely because they are easy to execute and then to preserve your margin. So that's my conclusion for today.